Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the Japan-focused, actively managed collectives that sits within our new list of 72 favourite funds, namely Baillie Gifford Japanese. The fund's mandate is to provide capital growth for investors over the long term, which is defined as a period of at least 5 years. The fund seeks to deliver this capital growth by building a portfolio of Japanese stocks. Co-fund managers Sarah Whitley and Matthew Brett run a concentrated portfolio of just 60 stocks, and turnover is light, as you would expect given the 5-year plus time horizon. Current key investment themes include the internet and robotics, both areas where Japan is blessed with a number of firms that have strong competitive positions. Whitley and Brett also constantly look for ways to play the social and economic reform programme launched by Prime Minister Shinzo Abe, known as Abenomics. As I sit here, the largest portfolio positions include telecoms and internet giant SoftBank, oil and gas explorer Inpex, the Sumitomo Mitsui Bank, online retailer Start Today, and robotics company Yaskawa. By sector, tech, consumer cyclicals and industrials are the three biggest sector exposures at 24%, 18% and 14% of the portfolio respectively. That's over half in total. By contrast, there is zero weighting toward utilities, just 2% in real estate and 4% in basic materials, as we can see here. Large caps currently represent just over 2/3 of the assets, mid caps just over a quarter, and smaller micro caps the rest. The fund is eligible for SIPs, ISAs and dealing accounts, and currently comes with a lowly yield of 0.63%. Again, this reinforces the fund is best suited to those investors seeking capital growth rather than income, although Baillie Gifford Japanese does come with income units where dividends are paid out, although on this occasion we're discussing the accumulation units where dividends paid are reinvested for you automatically. The ongoing charge figure is 0.68%, so you do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. So, those are the mechanics. The question to address next is why could investors consider this collective for their portfolios today? And I think there may be 3 possible reasons. First, well, that's Japan's Nikkei 225 index is going pretty well. The benchmark's nearing the 20,000 mark for the first time since late 2015, as we can see here. Despite that, however, Japan does not trade at or anywhere near its all-time high, unlike, say, the UK, US or Germany, so investors may argue there's a sniff of value to be had. Second, the fund's performance is good. It ranks top out of a field of 51 over a 5-year view, something from which patient capital gain seekers may draw comfort. Here's the chart. The third reason is Abenomics itself. Japan's political scene is dominated by Prime Minister Abe, and the calm here, while unusual this century, contrasts markedly with the US, Western Europe or even possibly the UK. In addition, Abe's reforms are being supplemented by an accommodative Bank of Japan, which is holding interest rates at minus 0.1% and also running a massive quantitative easing or QE scheme designed to boost the economy. You could argue it's working. Japan's just put together 5 consecutive quarters of annualised GDP growth for the first time in a decade. In addition, Japanese firms are increasing dividends and buying back stock as they take a more proactive view to shareholder relations encouraged by the Abe programme. Now, none of this is to say Baillie Gifford Japanese will suit every investor's overall strategy, target returns, time horizon or appetite for risk. The absence of a decent yield may put some off, and the portfolio's focus on tech does mean there is scope for short-term volatility even if the long-term record is good. There's also the risk that Abenomics doesn't deliver. GDP growth may be improving, but the overall record is spotty, a weak yen may have helped here, and inflation is still only 0.4%. That's actually despite 2 decades in Japan of zero interest rates QE schemes which have crushed 10-year government bond yields as per this chart. Japan's sovereign debts make those of Greece look modest. Its demographics are awful, the population is ageing and shrinking, and the country has flirted with deflation ever since its debt-fueled real estate and stock market bubble popped way back in 1989. There's also the nagging suspicion that Prime Minister Abe and the Bank of Japan are happy to sacrifice the yen to help boost the economy, so investors could potentially lose a portion of any capital gains they make to the currency. At least a lot of these issues are hardly new, And with the Nikkei trading at barely half that 1989 high, you might think a lot of people have given up on Japan, which may at least appeal to contrarians for starters. Nevertheless, you should do your own research before deciding whether to put any capital to work or not. Thank you for watching, and I look forward to seeing you next time.